Welcome to Top Tickers, where we break down the earnings calls that are moving the market. Today, we're digging into the latest from MoneyHero, ticker MNY. And wow, this one was a head-scratcher. You had management painting a picture of a huge turnaround, but at the same time, the market was hitting the sell button, and hitting it hard. So what's really going on here? Let's get into it.
Okay, so this slide really sets the stage for the whole drama. In one corner, you have the company's management, calling this quarter a major inflection point towards real, structural profitability. But in the other corner, you have the market, which took one look at the report and sent the stock cratering down about 21% on massive volume. Our job today is to figure out why this disconnect is so massive.
So, what did the numbers actually say? Well, this is where it gets interesting. MoneyHero's third quarter results were sending some seriously mixed signals. Honestly, depending on which line item you looked at, you could tell a story of incredible progress or a story of a big disappointment.
And right away, you can see the split personality in these numbers. The top line, revenue, came in at $21.1 million, which was a tiny beat against what analysts expected. No big deal there. But the profit story? That's where things get wild. The official by-the-book IFRS earnings per share was a huge miss, but then adjusted EBITDA, which is the number management really wants you to focus on, showed a really nice improvement from last year. This exact divergence is the key to this whole story.
Let's zero in on this number because this, right here, was the first huge red flag for investors. The official IFRS earnings per share came in at a loss of 10 cents. Now, Wall Street was only expecting a 2-cent loss. That's a 400% miss. For a lot of professional investors, that was the only number they needed to see before they started selling.
But management wants you to just look away from that and focus over here. They spent a lot of time on the call talking up the 68% year-over-year improvement in adjusted EBITDA loss. They narrowed it from a negative $5.5 million last year to just negative $1.8 million this year. This is the core of their entire story, that operationally the business is getting much healthier, leaner, and it's marching towards profitability, even if the official accounting rules don't quite show it yet.
And that brings us right to the bull case. CEO Rohit Murphy and the new CFO Danny Leung spent pretty much the entire call laying out this really optimistic vision for the company's future, trying to frame this quarter as absolute proof that their turnaround strategy is working.
This quote from the CEO really says it all. He's basically telling investors, hey, you got to look at us on a multi-year journey. They're asking the market to look past the kind of noisy numbers from this quarter and focus on the much bigger picture of a very deliberate, phased turnaround plan.
And here's that 3-year plan in a nutshell. Last year, 2024, was all about cutting the fat, pruning businesses that weren't making much money. This year, 2025, is about rebuilding with much better economics. And then 2026, that's supposed to be when they hit the accelerator on profitable growth. It's a clear, logical story they're trying to sell.
Now, a really crucial part of that rebuild phase is the mix of what they're selling. They're making a very deliberate shift away from the lower-margin credit card comparison business and moving towards higher-margin stuff like insurance and wealth. Those now make up 23% of total revenue, and management says these products deliver twice the profitability. So that's a big deal.
The secret sauce that's supposed to be driving all this efficiency? Well, they've given it a pretty cool name, Project Odyssey. This is their big AI initiative. They're saying it's already automating 70 to 80% of customer service queries. And get this, it's helped them slash their tech costs by more than half compared to last year. The grand vision here is to transform from just a comparison website into what they're calling an AI-native financial decisioning platform.
Okay, so the turnaround story sounds pretty compelling, right? You've got a clear plan, you're shifting to higher margin products, and you have this cool AI engine driving down costs. So how on earth does all of that positive news lead to a 21% drop in the stock? Why didn't the market buy a word of it?
This is the million-dollar question, isn't it? A drop this sharp, on trading volume that's 3 times the average, that tells you something important. This wasn't just a few retail investors getting spooked. This was a stampede for the exits, and it suggests the big institutional investors fundamentally rejected the story management was telling.
First, a little context is really important here. MoneyHero hasn't exactly been a star performer. Over the past year, it's lagged behind both the broad market, the S&P 500, and its own fintech peers. So what that means is investors were already coming into this earnings call with a pretty healthy dose of skepticism. They weren't exactly in a forgiving mood. So when the numbers dropped, the market basically ignored that whole turnaround story and honed in on a completely different set of facts. They saw revenue growth of just 1%, which is pretty anemic. They saw that deep, official IFRS net loss of $3.5 million. They also saw a stock that had already run up 43% for the year, meaning a lot of good news was already baked in. You could say it was priced for perfection, and this quarter was anything but. And finally, they just saw major execution risk. Is this whole AI story a real profit driver, or is it just a nice narrative for a PowerPoint slide?
And this slide really sums up the whole disconnect. It's like management and the market are speaking two completely different languages. Management is selling a future promise, talking about being profitable in 2026. But investors, who just got burned by that big IFRS miss and anemic growth, are totally focused on the here and now. They're de-risking, they're selling first, and basically saying, show me the real profits, then we'll talk.
So, after all that, where does that leave us? As analysts, our job is to weigh management's compelling story against the market's absolutely brutal verdict. So, let's get into our take on what to expect from here and how we're officially rating the stock.
We're initiating coverage with a market perform rating. So what does that mean? Well, basically, we expect the stock to perform more or less in line with its fintech peers over the next year. We think the bull case actually has merit. The story makes sense, but the execution risks are very real, and the market is now squarely in show-me mode. The story's good, but the hurdles are high.
So, what's our prediction for the next earnings call? Well, for Q4, we do expect them to hit their adjusted EBITDA target. Why? Because you can always cut more costs to get there. The real challenge, the much harder task, is going to be getting that top-line revenue growing again. Because of that, we expect the stock to be pretty volatile and stuck in a trading range for a while. It needs to prove it can deliver sustainable, official IFRS profit, not just these adjusted numbers, to really break out and run higher. So for now, the turnaround is plausible, but it's not yet proven, which is why we're sticking with market perform.
And as always, a reminder that this is not financial advice. All of the information we've presented today is for educational purposes only.